eBay is one dividend stock down 46% off its highs that I think you might regret not buying on the dip. In this video, I'll talk about why I think that's the case, starting with the company's dividend yield, and then I'll finish with the company's valuation. Let's begin. So, eBay's offering investors right now a reasonable dividend yield of 2.09%. Now, that might not be as high as the government yield 10-year bond is offering right now. But what you get with eBay that you won't get with the 10-year government treasury bond is that eBay could potentially increase its dividend payments over time. In fact, investors in eBay stock today can reasonably expect eBay to increase its dividend payment over the next decade. So looking at eBay's revenue over the last decade, you could see a nice upward trend here, going from a little over $8 billion in revenue and finishing close to $9.795 billion in revenue in its most recent year. Now, eBay does do a lot of acquisitions and I should say not a lot, but it does do a reasonable amount of acquisition and divestiture activity. That's how you see the big jumps in revenue and big decreases in revenue, because overall eBay's business is relatively stable, doesn't grow revenue very quickly, and doesn't decline in revenue very quickly either in terms of its core operations. These big fluctuations are acquisitions and divestitures that have caused its revenue to jump or decrease. Now, one of my favorite things about eBay stock is its healthy operating profit margin. Look at this over the trailing 12 months, looking back an entire decade. eBay's operating profit margin is consistently above 20%, and at times it has risen over 30%. So it goes up and down, but for the most part, it's been above 20%. And this could be for several reasons that I will discuss right now, and one of which being that eBay doesn't own any of the inventory on its platform. It just brings together buyers and sellers. Additionally, eBay doesn't deal with the shipping and handling. That's a big difference from other e-commerce platforms like Amazon or Shopify that are getting more and more entrenched in dealing with the shipping and handling and fulfillment, which can be very expensive and very risky, right? You put out billions of dollars in the hopes that you can reach a scale large enough to where you can reap a reasonable return on investment. eBay has said forget that. You buyers and sellers, you deal with that together. You discuss shipping and handling, what kind of service you want. We'll just bring you two together. You buy what that person is selling, and we'll take our fee for bringing you two together. That's what I like from an investor standpoint about eBay stock, is that it's asset-light business model. It's not risky. It's not fixed cost intensive in terms of the shipping and handling. It's just a platform, and it's already invested the big chunk of what it will need to invest to bring that platform online, make it operational, attract the millions of sellers and the over 100 million buyers that frequent the platform on a regular basis. So the big chunk of the work is already done for eBay. It just needs to make incremental improvements to the platform, incremental investments to solve critical needs for where it sees the majority of its buyers and sellers are. And so that's why you get eBay at operating profit margins above 20%, where Amazon is consistently below 10%, in fact, never above 10% operating profit margin. Shopify just turned hugely negative in terms of operating profitability. I don't like that kind of risky, capital intensive business model. I prefer what eBay is doing here. And as a bonus, the industry overall, they're all undertaking price increases, right? So if you might be aware that Amazon has increased fees it charges its sellers on the platform due to several reasons, right? It noted that higher inflation, higher gas prices, and so we're going to pass along those costs onto some of the sellers. The sellers were upset, but they had little they could do because all the other platforms are also raising fees on the sellers. eBay has increased its transaction take rate, which is the fee it charges sellers for each transaction, from around 8.5% several years ago up to over 13% in the most recent quarter. That's the same trend with Etsy. Etsy has increased its transaction take rate almost at 20%. So even though eBay has continued increasing its transaction take rate, it's got even more room where it can continue growing. Shopify also has increased the fees that it's charging sellers because it's rolling out more services. It's spending more money to offer more to its sellers, so it's charging more to the sellers. So sellers, it's not like they could go somewhere and avoid higher prices, right? The industry overall is increasing prices on sellers. That's another good reason to invest in eBay stock. I always talk about industry competitive forces as a significant force determining whether or not you want to invest. You like to invest in industries that have decreasing competitive forces. In other words, higher prices, less advertising, less promotional activity. That's all good news for investors, right? And eBay is certainly in that sweet spot where the industry is increasing prices, promotional activity is decreasing. So another positive side effect of that asset light business model is this cash flow from operations to sales being healthy over the last decade. You look at this metric again, above or near 25, 20%, going even higher at certain points. Again, this is because the company doesn't need to make these large capital investments, doesn't need to spend a lot of cash in order to maintain, sustain its business, sustain a competitive advantage. That's another great reason for dividend stock investors. As eBay's profits grow, eBay can allocate a greater share of that to dividends because it doesn't need to spend on these big projects on shipping, handling, warehouses, trucks, vans, planes. All of that doesn't need to do that. So that when there is a big influx in profits, a greater share of that can go to dividends. So if you're a dividend stock investor, that's why I said you can reasonably expect eBay to continue increasing its dividend over the next 5 to 10 years. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And finally, another reason why I think you might regret not buying eBay stock on this dip is because of its relatively cheap valuation. It's trading at a forward price to earnings ratio of 9.541, the cheapest, close to the cheapest this stock has been for a couple of years now, according to this metric. So you haven't been able to buy this stock at a lower price for a long time. In fact, it used to be trading at a forward price to earnings close to 20. So you're getting it at half that valuation. And you get a company with all of the positive aspects I highlighted in this video at a reasonably cheap price. So for all of those reasons, I think eBay is a dividend stock that you might regret not buying on the dip right now. All right, so that's all I've got for this video. Thank you so much for watching. I picked some videos that I think you'll enjoy that are popping up on your screen right now. Click on one of those, please, and I'll see you over there.